Here's something that happens constantly. Someone decides they're finally going to start investing. They sit down, open a brokerage account, and immediately face a menu of options that reads like a foreign language. Index funds, mutual funds, ETFs, hedge funds, and instead of picking one and starting, they spend 3 weeks reading Reddit threads and then do nothing. Because the terminology made them feel like they'd missed a class that everyone else attended in their 20s. It's like being handed 4 different keys and being told they all open doors. But nobody explains which one opens which door. I was there too. When I first started investing, these 4 terms showed up everywhere, and nobody explained the difference. Today, I'm going to cut through all 4 of these terms in plain language. What each one is, how it works, what it costs, and who it's for. Before we separate them, let's establish what they all have in common, because this is the part that makes everything else make sense. Think about a vending machine stocked with 500 different snacks. You could buy each snack one at a time, 500 separate transactions. Or you could buy one token that gives you a tiny piece of every single snack in the machine. That token is a fund. All 4 of these pool money from many investors and use it to buy a collection of assets. One transaction, automatic diversification. What makes them different is everything else. Who's picking the snacks, what they charge, and whether you're even allowed in. And, most importantly, whether the person picking the snacks actually does a better job than just buying all of them. The answer, for 3 of these 4 funds, is almost never. The mutual fund is the oldest of the 4. A professional portfolio manager picks stocks they believe will outperform. You pay them for this expertise. They charge you whether they're right or not. The average actively managed mutual fund carries an expense ratio of 0.87%, according to Morningstar 2025. 79% of actively managed large-cap U.S. equity funds underperformed the S&P 500 in 2025, according to SPIVA. Zoom out to 20 years, and approximately 92% of domestic funds lag their benchmark index. 9 out of 10 professional managers over a long enough horizon lose to the market they're trying to beat. After charging you for the privilege, here's the counterintuitive answer to the mutual fund problem. It's been sitting in plain sight since 1976. An index fund doesn't try to beat the market, it owns the market. It buys and holds every stock in a given index. The S&P 500, the total U.S. market, the global market, in proportion. No manager is selecting stocks. No one is predicting which sector will outperform. The fund just mirrors the index. And that low cost is the entire competitive advantage. Industry average expense ratio for index funds, 0.04% to 0.17%. $83 annual difference. Compounded over 30 years on a $100,000 portfolio, that gap represents tens of thousands of dollars. 2 investors. Same starting amount, $50,000. Same monthly contribution, $500. Same time horizon, 30 years. Investor A. Actively managed mutual fund, 0.87% expense ratio. Ends up with approximately $530,000 to $550,000 after 30 years. Investor B. Low-cost index fund, 0.04% expense ratio. Ends up with approximately $620,000 to $640,000. The gap, roughly $85,000 to $90,000. Purely from the difference in annual fees, compounding silently against Investor A for 3 decades. Not from better stock picks, not from timing the market, purely from what each fund charges annually. If this is reshaping how you think about your investments, give it a like. It helps more people find this. An ETF, exchange traded fund, is not a different investment strategy. It's a different wrapper around the same strategy. Most ETFs are index funds. They own the same basket of stocks, track the same benchmarks, charge similarly low fees. The structural difference. A traditional index mutual fund is priced once a day at market close. An ETF trades in real time on an exchange. For long-term investors building retirement wealth, This ETF versus mutual fund timing distinction matters less than most people think. What matters is the expense ratio and the underlying assets. On both fronts, low-cost index ETF and low-cost index mutual fund are close to identical, where ETFs have a genuine structural edge. Tax efficiency in taxable accounts. When you sell a mutual fund, it may have to sell underlying securities and distribute capital gains to all shareholders, including you, even if you didn't sell. ETFs typically avoid this because shares are exchanged between buyers and sellers on the market, not redeemed through the fund. If you're in a taxable brokerage account, the ETF's tax efficiency edge matters. Retirement account doesn't matter much. And then there are hedge funds, which operate in an entirely different universe, one that most people watching this video are legally not allowed to enter. Hedge funds are private investment partnerships open only to accredited investors, net worth over $1 million or income over $200,000 for 2 years. They use sophisticated strategies, short selling, leverage, derivatives, arbitrage, to generate returns regardless of market direction. For this complexity and exclusivity, they charge accordingly. The standard fee? 2 and 20. 2% annual management fee charged on your total assets, regardless of performance, plus 20% of any profits. The average hedge fund returned 11.5% in 2025, trailing the S&P 500 by 11.8 percentage points, according to Lambda Finance, aggregating HFR data. After the 2% fee and 20% performance cut, the net return to investors shrinks further. Most Americans are excluded. Based on the data, they're not missing much. Here's the framework that cuts through everything. 3 dimensions. Who manages them? What they cost? Who's allowed in? Mutual funds, actively managed, high cost averaging 0.87%, open to almost everyone. Performance lags the index in 79% of cases yearly, 92% over 20 years. Index funds, passively managed, very low cost at 0.04% to 0.17%, open to everyone with a brokerage account. Performance matches the index, which beats most active funds. ETFs, same as index funds in most cases. Structural tax advantage in taxable accounts. Real-time trading. Same low cost. Same open access. Hedge funds, actively managed with complex strategies. Fees of 2% plus 20% of gains, open only to accredited investors. Performance has generally lagged the S&P 500 after fees. One dimension is doing most of the work here. Cost. Low cost is the variable that explains almost everything. Low-cost index funds and ETFs outperform the alternatives, not because they're smarter, but because they charge less. Every dollar not spent on fees is a dollar that compounds. So here's the summary. Mutual funds are the traditional vehicle, actively managed, higher fees, statistically likely to underperform over long periods. Index funds simply own the market, and by doing so, beat most professional managers over time. ETFs are index funds with a structural tax advantage and the flexibility to trade throughout the day. Hedge funds are complex, expensive, and exclusive. And the performance data suggests the exclusivity is not quite the privilege it sounds like. For most Americans, building wealth over 20 or 30 years, the answer is boring and reliable. A low-cost index fund or ETF, held consistently for 20 or 30 years, contributes more to long-term wealth than almost any other portfolio decision. The most powerful investing strategy is also the least complicated one. This content is for educational purposes only and is not financial advice. If this helped clarify something that's been confusing for a while, subscribe and drop a comment telling me which of the 4 you're actually using. See you in the next one.